And every great market boom, there's a moment when the story flips. For the public, it feels like victory. For a small group of investors, it feels like the exit sign lighting up over the door. In 1929, that moment came months before Black Tuesday, when Joseph Kennedy quietly left the party and then made a fortune as Wall Street burned. In the mid-2000s, it arrived when a handful of analysts like Michael Burry and John Paulson stopped looking at CNBC and started reading the fine print inside subprime mortgage bonds. And today, in the mid-2020s, that moment may already have passed again, while most people were still cheering record highs and AI headlines. This isn't luck. It isn't some mystical sixth sense that geniuses are born with. It's a pattern, a process, a four-stage playbook that repeats across decades. Exit early while the crowd is still euphoric. Buy insurance on the system itself. Target the weakest structures with precision shorts. Show up with cash when everyone else is selling in panic. Most investors only ever see the last stage, when the same names show up buying everything on sale after a crash, and they call it brilliance or bravery. What they don't see are the three stages that came before: the quiet selling, the strange trades that lose money for a while, the bets placed against things everyone still believes are safe. Those moves are not random. They are almost scripted. We've watched this script before. The Roaring Setup, 1929. In the late 1920s, America felt invincible. The Roaring Twenties were more than a nickname. They were a narrative. Radios, cars, skyscrapers, mass production, a sense that history itself had broken into a sprint. Stocks became the symbol of that optimism. Buying on margin, borrowing to buy more shares, was not a niche tactic, it was the culture. Small investors could put up 10% cash and borrow the rest from their broker. A 10% decline didn't just hurt, it wiped them out. By 1929, margin debt had exploded to levels the financial system had never seen. The entire market was sitting on a tower of leverage. Joseph Kennedy was not some gentle, long-term investor. He had spent the 1920s inside the machinery, running stock pools, engineering price ramps, understanding how a few big players could push prices around in illiquid markets. He understood not just prices, but plumbing. The famous story says his signal to get out came when a shoe shine boy offered him stock tips. If the kid shining shoes was trading, Kennedy thought, there was no one left to buy. It's a good story. It captures the mood, but it's only part of the truth. The deeper reason was simpler and colder. He saw margin debt levels. He understood what forced liquidation looks like. He knew that when prices fall even a little, the leverage itself becomes the weapon. Margin calls for forced selling drives prices lower, and the spiral feeds on itself. So during the summer of 1929, while newspapers were still printing bullish headlines, Kennedy and a small circle of veterans like Bernard Baruch began to do the most boring, unglamorous thing you can do in a bull market. They sold. Not all at once, not dramatically, systematically. They liquidated positions into strength. They reduced leverage. They raised cash. This is stage one in its purest form. Exit 12 to 18 months before the actual crash, not because you know the date, but because you know the math. Baruch had seen an earlier panic up close, the crash of 1907, when there was no central bank and no lender of last resort. He recognized the smell of a market that had climbed too far on borrowed money and belief. By early September 1929, both men were largely out. On September 3rd, the Dow Jones Industrial Average peaked at 381. 7 weeks later, on October 24th, Black Thursday, the cracks became visible to everyone. Kennedy and Baruch were not clairvoyant. They were simply willing to look ridiculous early rather than be destroyed late. The subprime echo, 2005 to 2007. Fast forward nearly 80 decades. Different era, different assets, same pattern. In the mid-2000s, the bubble wasn't in industrials and utilities. It was in housing. House prices rising far faster than incomes. Mortgages handed out to borrowers with no documentation. Adjustable rates that would reset higher, almost guaranteeing distress. Financial engineers slicing these loans into complex securities stamped AAA. On the surface, the story was homeownership for everyone and risk sliced and diversified. Underneath, it was leverage stacked on leverage. Michael Burry did something most investors didn't bother to do. He opened the hood. Instead of treating mortgage bonds as tickers on a screen, he pulled the loan level data. He read the terms. He looked at the borrower's FICO scores, incomes, reset schedules. What he found was not a mild imbalance, it was a bomb with a clock on it. John Paulson, coming from a different starting point, macro analysis of housing versus incomes and rents, reached a similar conclusion. The U.S. housing market was wildly detached from reality. Here's where the pattern rhymes with 1929. They didn't wait for CNBC to ring a bell. They didn't wait for confirmation from the crowd. From roughly 2005 onward, they began leaving the consensus trade, selling housing-linked equities, avoiding the hottest sectors, moving capital into positions that would only pay off if the narrative broke. Burry even had to invent his instrument, credit default swaps on specific mortgage bonds, because Wall Street hadn't thought of a way to short the bubble yet. For almost 2 years, his positions bled money. His investors were furious. Some demanded their capital back. But that is what stage one looks like in real time. You sell strength while everyone else is euphoric. You start building hedges while the story still sounds good. You endure mockery, career risk, and boredom. Then in 2006, U.S. home prices peaked. By 2007, subprime defaults began to ripple through the system. By 2008, the structure collapsed. The pattern from 1929 had reappeared in a new costume. Stage 1, again. 2024-2025. Which brings us to now. If you zoom out from the day-to-day news cycle and look at the behavior of people who've lived through multiple cycles, a familiar image emerges. Warren Buffett's Berkshire Hathaway sitting on an unprecedented pile of cash, hundreds of billions, complaining publicly that nothing is attractively priced. Tech founders and insiders, Jeff Bezos at Amazon, Mark Zuckerberg at Meta, executives across corporate America, systematically selling large blocks of stock into strength. Insider selling metrics flashing levels eerily similar to 2007, right before the last major crisis. The public sees diversification, estate planning, or shrugs it off as noise. But in aggregate, this is exactly what stage one has always looked like. The people closest to the real numbers quietly hand their shares to late-arriving optimists. Overlay that with valuation signals. The ratio of total stock market value to GDP, often called the Buffett indicator, blown far beyond the range he once labeled dangerous. A decade of cheap money having inflated not just tech stocks, but private equity, venture capital, and even safe haven assets. Nobody knows the exact hour of the next break, but the shape of this moment, the leverage, the confidence, the insider behavior, would be instantly recognizable to Kennedy, to Baruch, to Burry. We are, by every historical rhyme, deep inside stage one. The part of the movie where the exits are technically still open, but where almost nobody believes they'll need them. What happens next is where the pattern stops being invisible and starts being profitable for a very small group.
Stage 1 is where the doors quietly close. Stage 2 is where the fire insurance gets written, while the building still looks perfectly safe. Most investors never notice this phase because it doesn't look like panic. It looks like small, boring line items. Premiums paid. Options purchased. Strange little positions that lose money month after month. But for the investors who've already stepped out of the crowd, Stage 2 is where survival turns into opportunity. Stage 2. Buying volatility before the crowd smells smoke. If Stage 1 is exit early, Stage 2 is buy insurance on the system itself, while it's still cheap. In modern markets, that means buying put options on major indices or key stocks, options on volatility itself, VIX calls, credit default swaps on bonds that look safe but are structurally rotten. The key is timing. You do it before everyone's terrified, when volatility is low and insurance is mispriced. Let's go back to our two big historical mirrors. 1929, shorting the dream. In 1929, there were no VIX options, no CDS, no ETFs. Insurance was cruder, but the logic was identical. After Joseph Kennedy and Bernard Baruch had sold down their long positions into the summer of 1929, they did something deeply unfashionable for the time. They started shorting. Shorting is brutally simple in concept and psychologically difficult in practice. You borrow shares from someone who owns them. You sell those borrowed shares at today's price. You hope to buy them back cheaper after a decline, return them to the lender, and keep the difference. If the stock falls from $100 to $40, you pocket $60. If it rises instead, your losses can be unlimited. In the months before the crash, Kennedy and a few others quietly built these short positions in companies they believed were badly overextended. They paid borrowing costs, a kind of premium, watched prices drift higher, endured the feeling of being wrong every day the market ticked up. Their timing wasn't perfect by the hour, it never is, but it didn't need to be. When the break finally came, Black Thursday, October 24th, Black Monday, October 28th, the panicked weeks that followed, those short positions flipped from a slow bleed to a money-printing machine. As prices collapsed, the insurance paid. Where ordinary investors were forced to sell at any price just to meet margin calls, Kennedy was buying back the shares he'd sold short, now at a fraction of the price, locking in profits while the market melted. The lesson wasn't that shorting is glamorous, it's that insurance looks insane right up until the moment it doesn't. 2005 to 2008, the invention of the perfect insurance contract. Michael Burry and John Paulson added another layer to this. They weren't just betting against stocks tied to housing, they were buying insurance on the plumbing itself, on the mortgage bonds that Wall Street had promised were rock solid. The tool was a credit default swap, CDS. Think of a CDS as fire insurance on a building. You pay a small premium every year. If the building never burns, you wasted the premium. If it burns down, the insurer pays you the full value of the building. Burry looked at the mortgages inside certain subprime bonds and concluded, quote, "This building is full of gasoline and bad wiring," end quote. So from 2005 onward, he went to investment banks and said effectively, "Create an insurance contract for me on these specific bonds. I will pay you premiums. When, not if, they blow up, you pay me." For 2 years he looked wrong. U.S. housing prices kept rising. Mortgage delinquencies remained disguised by teaser rates and refinancing. His fund bled cash paying those insurance premiums. His investors complained. Some called him reckless. Some tried to pull out. But he understood stage 2. You don't buy insurance after the fire trucks show up. When defaults finally started to spike in 2007, the CDS prices began to rise. By 2008, as Lehman failed and the system seized, those contracts went vertical. A few million in annual premiums turned into hundreds of millions in payouts. For Paulson, who had scaled this to tens of billions in notional exposure, the result was one of the largest single trades in financial history, over $15 billion in profit. It wasn't magic, it was a time delay between when reality changed and when the crowd accepted it. Stage 2 lives inside that delay. A Modern Masterclass, March 2020. If you want a compressed version of Stage 2, look at Bill Ackman in early 2020. As news of COVID spread and markets wobbled, Ackman bought credit protection, insurance on corporate debt, at a moment when the virus was still considered manageable by most investors. Volatility was elevated but not extreme. Credit spreads had barely begun to widen.
He spent about $27 million on these hedges. Within weeks, when the panic truly hit and markets plunged over 30%, those same positions were worth roughly $2.6 billion. A 96-to-1 payoff. Not because he knew exactly how far the market would fall, but because he bought fear insurance before the fear fully arrived.
Then he did something even more important, which we'll return to in Stage 4. He flipped. He used those insurance profits to buy stocks at crisis prices while everyone else was still frozen. Insurance on the way down, ownership on the way back up. The pattern again. 2024-2025. The quiet surge in protection. Now look at where we stand today. You won't see the next crash announced in a headline, but you can see its probability reflected in how much people are willing to pay for protection. And right now, sophisticated investors are paying up. Some of the signals. Put-call ratios. The ratio of put options, bets on downside or insurance, to call options, bets on upside, has been elevated for much of 2024-2025. In calm, bullish periods, calls dominate. When big players quietly fear a break, puts start to build. VIX calls. The VIX index measures expected volatility in the S&P 500. You can't trade the index directly, but you can buy options on it. Large institutional-sized purchases of VIX calls expiring in mid and late 2025 have appeared. Bets that turbulence will spike in that window. Credit default swaps on commercial real estate and corporate debt. The cost of insuring certain commercial mortgage-backed securities has climbed sharply. Why? Because office towers are half empty. Refinancing is happening at much higher interest rates, and the math on many loans simply doesn't work. Somebody is paying for that insurance because somebody has done the numbers. None of these things in isolation scream crash tomorrow, but together they rhyme with what we saw ahead of 2008. Cheap insurance becoming less cheap. Hedging activity shifting from background noise to structural trend. A small group willing to bleed premiums now for the right to collect later. Stage 1 was visible in record insider selling and massive cash piles. Stage 2 is visible in the options chains and credit markets, the places where professionals quietly wire their fear into prices. For most people, this phase passes unseen. Their brokerage screen shows green. The index is near a high. Their app shows line charts, not derivative flows. But underneath, more and more sophisticated players are doing the same thing Burry did in 2005, the same thing Kennedy did in 1929, the same thing Ackman did in 2020.
They are paying to be on the right side of panic before panic is officially declared. And when that panic finally arrives, Stage 2 positions don't just protect capital. They create liquid ammunition, cash that can be redeployed at the exact moment everyone else is being forced to sell. That's where Stage 3 begins. Because once you've exited and insured, there's one more brutal, surgical step the crash architects take. One that doesn't just hedge the system, but targets its weakest beams directly.
Stage 1 was the quiet exit. Stage 2 was the invisible insurance. But Stage 3 is something else entirely. The move that separates the merely cautious from the architects of generational wealth. If Stage 2 is buying fire insurance on the building, Stage 3 is identifying exactly which floors will collapse first and placing precise bets on their failure. This is the part of the cycle where the smart money stops preparing and starts positioning. Not broadly, not vaguely, but with surgical precision. Stage 3. Shorting the first dominoes. In Stage 3, sophisticated investors don't short the entire market. That's expensive, blunt, and imprecise. Instead, they pinpoint the exact sectors built on leverage, fantasy, or denial. Analyze where stress is silently accumulating. Determine which balance sheets won't survive a tightening cycle. And then they place targeted short positions that will pay out the moment cracks appear. It's not timing the crash, it's identifying the structural weak spots guaranteed to fail when pressure rises. History gives us the blueprint. 1929, the weakest leverage fails first. By late 1929, Joseph Kennedy and Bernard Baruch already held cash and short positions. But Stage 3 required more than just betting down. It meant recognizing where the speculation was most extreme. The answer was margin. The 1920s version of rocket fuel poured on a fragile foundation. Investors were borrowing up to 90% of their stock purchases. A mere 10% decline would wipe them out entirely. A 20% drop would force mass liquidation, not because investors wanted to sell, but because brokers forced them to. Kennedy understood this mechanic deeply. He targeted stocks heavily owned by leveraged speculators, pumped up by stock pools, supported by thin liquidity, and vulnerable to panic selling. When the crash came, these stocks didn't just fall, they evaporated. The short positions that looked painful during the final weeks of euphoria became wealth machines. Kennedy's fortune, later used to fund a political dynasty, was minted not merely by exiting, but by targeting the precise pillars that would collapse first. 2007-2008. The precision turns mathematical. In 2008, Stage 3 evolved. Michael Burry and John Paulson didn't bet against the housing market. That's too broad and inefficient. They identified which tranches of mortgage bonds were filled with the worst loans, which regions had the most insane speculation, which structures would fail first when teaser rates reset, and which borrowers were mathematically guaranteed to default. They used loan-level data, tens of thousands of individual mortgages, to find patterns. Teaser loans resetting in 2007, stated income loans with fictional earnings, borrowers with no down payment, properties flipped twice in 18 months, entire zip codes where home prices detached from local incomes. These weren't predictions, they were inevitabilities. Even if the economy didn't worsen, these borrowers would fail anyway. The math simply didn't work. So Paulson and Burry targeted specific tranches of specific mortgage-backed securities tied to specific regions
with specific default triggers. That granularity turned hundreds of millions of dollars in premium payments into tens of billions of dollars in profits. Stage 3 was not about fear. It was about forensic analysis of fragility. 2025. The modern dominoes are already leaning. Now we arrive at today. We are living through Stage 3 in real time, and most investors have no idea it's happening. Sophisticated funds, family offices, and billionaire investors are not shorting the market. They are targeting the exact sectors most vulnerable to a transition from cheap money to expensive money. Those targets are clear. Target number 1, commercial real estate, the next subprime. Commercial real estate, especially office buildings, has become the single greatest structural weakness in the U.S. economy. The issues are mathematical and irreversible. 1. Remote work is permanent. Vacancy rates in major cities. San Francisco, around 35%. New York, around 25%. Los Angeles, around 30%. Chicago, around 28%. These aren't cycle issues, they're structural. 2. $2.2 trillion in loans are coming due. Most of these loans were financed at 3% interest during the easy money years. Now they must be refinanced at 7 to 9%. The rental income hasn't doubled. The building's values have fallen 30 to 50%. The math doesn't work. The loans will fail. 3. Institutional investors are already walking away. When Brookfield, Blackstone, and PIMCO begin defaulting on buildings, not because they can't pay, but because they won't, the signal is unmistakable. These properties are worth less than the debt that funds them. Hedge funds see it too. They are buying credit default swaps on commercial mortgage-backed securities, puts on REITs concentrated in office space, shorts on companies exposed to the refinancing wave. This is Stage 3. Target number 2, regional banks, the weakest link in the system. Here's the brutal reality. Regional banks are the subprime lenders of 2025. They hold the majority of commercial real estate loans. When those loans default, these banks will face unrealized losses becoming realized losses, capital ratios collapsing, regulatory shutdown, forced mergers or failures. We've already seen the preview. Silicon Valley Bank collapsed. Signature Bank collapsed. First Republic collapsed. New York Community Bank almost collapsed. These were the tremors before the earthquake. Hedge funds are shorting banks with 25 to 40% commercial real estate exposure, banks in cities with the highest office vacancies, banks with weak deposit bases, banks holding underwater bonds from the 2020-2021 zero-rate era. This isn't speculation, it's arithmetic. Target number 3, overvalued mega-cap tech, the final domino. Not the good companies, those will survive, but the unprofitable AI-adjacent stocks, meme-fueled tech darlings, second-tier cloud providers, zombie SaaS firms whose valuations assumed free money forever. These will be the last to fall, but when liquidity dries up, the growth at any cost model collapses instantly. Stage 3 short positions are already building here too. Why Stage 3 matters. Stage 3 is the moment where the smart money transitions from defensive to offensive. They're not just protecting themselves, they're positioning to profit at scale. And unlike retail investors, they're not guessing. They're reading debt maturity schedules, refinancing rates, occupancy charts, CDS spreads, insider filings, capital adequacy reports, interest rate sensitivity models. They're not betting on a crash. They're betting that math is real.
Stage 3 is happening quietly, but the groundwork for Stage 4, the wealth transfer stage, is now being laid. The next stage is where everything accelerates. Stage 4 begins the moment fear finally hits the surface. And when it does, the entire map of opportunity changes in a single week.